a definition of beneficiaries. So what the FSC does is that the FSC monitors the investments, how the chairman performs. For my sins, I'm the chairman of the UTEC pension scheme, and I'm happy to tell everybody that there are 1,100 employees, and they had to have a new pension scheme because we came out of the government one. So we have a new pension scheme, as Mrs. Emmons will tell you. And at first, people didn't want to go into it because they were, distrust. Because Jamaica is a distrustful population. So I have brought them, when I got there, they had 300. I have now brought it up to 700 odd. And my goal is to get all 1,100 people into the scheme. And those persons who were not eligible for the scheme, I'm going to get them into IRAs, because there were some people who were too old to get into the scheme. So you try and channel them now into IRAs. And where it is that an organization can help to administer the channeling into IRAs, an organization should facilitate the employee by taking out the amount and passing it over to the insurance company or approved IRA provider, right? And I urge everybody, if you are an organization that does not have a pension scheme, encourage the workers to go this route of IRAs, right? And help them to administer it. But there's a danger, because Jamaican employers use the GCT and don't pay it over. So therefore, employees have to ensure that if it is the employer administers the payments into the IRA as deductions from salary, that they're actually paid over. Very important. Because on the tax side, you know that the bulk of delinquency is under the PAYE, where persons don't pay over the statutory deductions. They use it to finance their businesses, and the same with general consumption tax. Now, they defined beneficiary in the 2008 amendment. Now, what is a pension fund? It must be in connection with some economic activity common to the workers and covered by the plan. That is the criteria for you getting it. And annual payments to beneficiaries cannot exceed 2/3 of their amounts. Now, when it is you're coming out of the scheme, there used to be lump sum payments that were tax-free, right? Now, those amounts used to go up to about 120,000. Now, there is a new formula under the 2008 amendment that is a complicated formula. And I've set it out here for you so you can have the presentation. But what it does is give you far more, and Mrs. Hennes can attest, right? Far more on a tax-free basis than you ever got before. So if you are coming out of the scheme and you want a lump sum payment, you now have a formula that will give you a realistic amount. I will tell you that I got 1.8 million, which is far in excess of the 120,000 when I came out, okay? Now, you can't, you must have worked 37.5 years, and the amount cannot exceed 75% of the remuneration. If it is you're disabled and you have to come out early, then it is apportioned appropriately. Or if you die, then your dependents can get up to 2 years of your salary as a lump sum, or some other actuarial, that's where St. Elmo comes in, amount based on what you contributed. Now, the employer can make a decision to go up to 10% of the employee's salaries and put into an approved fund. Normally, employers go for the 5%. Before that, before 2008, employees could also go up to 10%. I made that decision way back when I started life as working person at Duncox and Art at the time, to go the 10% route. And I continued that until I came out of the scheme. And it benefited me greatly to have gone to the maximum. Now, the 2008 amendment under the Income Tax Act, but not entrenched in the Pensions Act. But despite the fact that Mrs. Hennes has not come up to speed, right?
Oh, no.
In the 2004 Act, if it is that your employer puts 5%, then you as the employee can opt to take up the other 5. And instead of putting just 10%, you put 15%. Because the law now allows the total contribution of 20% to be allowed for tax purposes. So therefore, if it is your employer puts 5%, you go to 15% and go to the maximum, right? That is the way forward to go. And remember, from the day you start working, if there's a pension scheme, get into it. If there's no pension scheme, you now have the IRA route, which we're going to go on to discuss. Okay? Now, despite the fact that the Pensions Act has not been amended to accord with the 2008, with the Income Tax Act, under the law, the later statute overrides the earlier statute. So therefore, the Taxpayer Audit and Assessment Department honors those contributions as tax-free, despite the fact that the amendments in the Pensions Act have not been accorded, right? So they honor these as deductions. Now, the accountants, my colleagues in this room, will tell you that a line item in your income statement as a deduction for tax purposes is the contributions of an employer to an approved pension scheme. It's a full deduction, right? And it, of course, it must be approved. Okay. And remember, the approval for tax exemption is by the Commissioner Taxpayer Audit. The approval as regards the operational, financial aspects of the scheme lies with Mrs. Hennis, who monitors us unbelievably well, right? And as to how the scheme is performing. And the rules under the Pensions Act are very stringent as to the types of investments that pension schemes can get into. Okay. Now, what is the benefit now? You know that if you got it for tax purposes, if you got it tax-free, when it is you paid into the scheme. So you are now putting, say, 15% into the scheme. When calculating the tax on your salary, that 15% is taken out before assessing you to tax. So you are not paying tax on it up front. But there are no free lunches when it comes to taxation. No free lunches. Absolutely none.